I'm proud to be here today representing a not marketplace lending fund manager, asset manager. We are in the equipment lease asset finance business, but it's an important part of the much broader the spectrum of alternative credit. So with that said, I think a lot of it isn't necessarily defined today. But what is kind of the base understanding or definition of alternative credit? And it's all financing provided by non-traditional sources. Traditional sources being banks, credit unions, governments, and I'd say insurance companies because they've been active in kind of the lending space for as long as they've been in existence. And insurance companies play an incredibly important part of the alternative credit world today. And we'll get into a little bit more about that. The first generation, really, of non-bank financial lenders goes back probably a lot longer than you would have realized. GMAC, for example, was established in 1919. I think that might surprise people to realize that there were kind of alternative funding sources beyond banks. IBM Credit Corp, while established much later, it has been around for long enough to be part of the legacy non-bank group, operating in 50 countries with $36 billion of IT financing. And then, of course, everyone knows GE Capital before it became an actual bank under kind of the post-restructured world to get TARP financing. GE Capital was the largest non-bank financial institution with $44 billion of revenue, $500 billion of assets under management in 2013. So who were these first-generation lenders or first-generation non-financial lenders? They were essentially manufacturing companies or service providers looking to finance their own products and services. So GMAC makes perfect sense like that. GE Capital, IBM, they all built these infrastructures to support their own base, which had kind of the natural progression to have an infrastructure that can be further leveraged to provide lending beyond their base kind of captive markets. Xerox Credit Corporation got into the business of leasing airplanes. Started out as kind of copiers, machines of that nature, became one of the major financing tools for assets like that in the 1980s. So this was kind of the state of being through 2008, 2009. You had a fairly efficient banking market, though I think anybody engaged in the market realized the bank has always been a bank, right? The favorite expression being a banker is the gentleman who will lend you his umbrella when the sun is shining and ask for it back when it rains. That's kind of been the bank reputation. But in 2008, 2009, things changed dramatically. Tight credit, I think, is fair to say, was an understatement. It really exemplified the situation where banks would only lend to you if you didn't need it. Yields approaching zero, since then, even negative in a lot of major markets. And what this did is it opened the market to fill the gaps left by banks. We, as a fund manager in 2008, 2009, had a particularly good time of cherry-picking opportunities in the market. So, while one would say that kind of entering the financial markets at that time is a bad decision, it's actually an excellent decision for the emergence of real alternative credit as an investment alternative. So, courtesy of David and AltFi, we got together and we did a little bit of brainstorming to say, what is this universe? And really being born of kind of the trends that were in place leading up through and accelerated by the 2008, 2009 timeframe. And of course, everybody's aware of the direct lending. Mezzanine debt, BDCs. BDCs have been very big here in the United States for the last couple of years. And that's an interesting reaction that the government has had with the BDC, because you have the BDC was really a response to the fact that banks were being forced by increasingly stringent regulatory requirements to maintain capital, limit their operations. So the government's looking at that pressure from small and mid-sized businesses to have liquidity in the market. So they set up a new structure under the Business Development Corporation intended to provide liquidity to that particular space. So it's really the government causing a problem on one hand, trying to solve it on the other. That's an interesting market. We're interested to see how that develops. But I think in the United States, the Business Development Corporation is a significant segment of this alternative credit being provided to essentially small to mid-sized businesses, because that's what it's about at the end of the day. The large institutions will always have capital markets available to them. They'll always have banking relationships. It's really, alternative credit is in response to the needs of small and middle-sized businesses, which is really the core of any real economy. So looking out there, of course, we've got the asset-based financed, which is ship financing, has always been somewhat non-traditional. Trade finance, structured loans, litigation finance. That's actually one of the more interesting ones that I've seen out there. Certainly, that's an asset class that I think has not gotten enough attention that we'll be seeing more of when people really start to understand that. And that's what it's really about. Events like this to give a platform to talk about these alternative credit strategies. So this is the basket, and it goes on kind of well beyond these. It's any situation where you have a non-bank providing financing for a business or a consumer. So why does it exist is what you ask, right? Or why is it important? Well, to borrowers, there are more options when none existed at times. We have this recent or this upcoming election where people spend a lot of time kind of being concerned which way it's going to go, one way or the other. But the reality is, as business owners, as operators, as general citizens, what we're really focused on is our business, the business of every day, the jobs that we have, the things that we do. And at the end of the day, regardless of what happens in the broader markets, we need to go to work. We need to operate those businesses. Those businesses need capital. If there's no capital available from the traditional system, there are going to be ways that capital is going to find its way into the system. That's why this alternative credit is incredibly important, and that's where these options now come to bear. And I think innovation has been tremendous in this space, as we'll explore over, I guess, today and just in general. The other effect that you're having here is you have a market with no options, which means cost of capital, it was very high if you could get it, and I think a lot of people would have been happy to take that capital. So if few entrants came into the market providing capital, the rates would inevitably be high. But what you have here is many entrants coming into the market, creating competition, meaning we're providing liquidity to a base at competitive rates lower than, I guess, kind of desperation seeking. So from borrowers, it's pretty clear. They had no options. They have many options at attractive, well-priced rates. To lenders, investors, yield premiums when none existed. And again, literally rates nearing zero was a real problem for insurance companies, for example, where you have a regulated organization that has a fixed pool of assets that it can invest in, but has a regulatorily required hurdle that it has to achieve. In 2008, 2009, it looked historically at that point to the securitization markets with a very attractive rated commercial paper. Securitization market essentially dried up. They looked for commercial paper, which was priced against relative bonds. Government bonds were at very low rates, which meant commercial paper was at low rates. So what you had as an array of insurance companies that had a hurdle to reach, but a universe of investments that wouldn't deliver those returns. And hence, again, another impetus to the alternative credit space, creating investment opportunities for non-traditional lenders. Another very interesting point that we are here is because there are so many different niches out there, you have an opportunity to develop and grab huge market share. That brings kind of the best in class into spaces like this, which means consumers are getting, again, healthy competition to deliver better product to them. It is something worth people's attention because it's financially very rewarding. So what's the downside? To the borrowers, it's really minimal. It's limited. There are limited cases of predatory lending. A relatively sophisticated borrower could probably weed that out. We talk a lot today about kind of the regulatory scrutiny. The regulators probably do less to protect than common sense does. They probably make it harder, actually, I think, in a lot of ways. To the lenders, Again, going back to the downside being kind of undefined or irrelevant regulatory environment. I think Rupert made a very good observation earlier this morning when he said that you have phone book-like regulatory disclosures that are not good for anybody. There's probably some relevant disclosures in there, but if they're just going to throw everything at the system and expect people to comply or be useful, I think that this is going to be a major hurdle in the industry getting over kind of the regulatory constraints. The other kind of downside here is going to the opportunity to grab market share also means that you're living and dying in a pre-culled industry. There's going to be certainly less participants tomorrow than there are today in certain of these more developed asset classes. That's good and bad, but it's going to get very competitive in certain segments very quickly, I think. So it breeds the question then, are shadow banks shadowy? The answer is some are. But some of everything is, right? Some dentists are. You can't write off an entire industry because maybe there are a couple bad participants. I think sophisticated investors have the ability to determine which are good and which are bad. However, most provide a vital need for both borrowers and investors, which is what we've really examined today. The question is, how do you tell the difference? It's still about the fundamentals. Rule number one, if it sounds too good to be true, it probably is. I think a lot of people get caught up in the hype. I think a little bit to David's point earlier, especially on the retail side, about the myth of technology and technology bringing in kind of a new paradigm of credit underwriting. The reality is that there is no new paradigm. It's still fundamental cash flow underwriting. And again, that's what we've talked about a lot today. It's having access to that data. And that data is available to us in unprecedented ways. It's David and I had dinner the other day, and he said it's really the old way of looking your client in the eye. It's all about getting to know your borrower. Data now tells us more about a borrower than they know about themselves. And that's where the technology really becomes an important part of this. It's not making credit decisions for us. It's not changing the way we're extending alternative credit. What it's doing is it's informing the credit decision that we're making based on fundamentals that have always been in place, literally for hundreds of years. It's been the fundamental premise between extending a loan or not extending the loan is, do you have good cash flow and collateral coverage? So basically, the technology is going to improve the integrity of the information that drives the lending decisions. That's a game changer, and that's going to allow scale and the ability to take these smaller micro loans and effectively extend proper credit and build better portfolios. So I want to give you an example of how we're using technology at SQN. We just recently developed a new program called SQN Latina. We're doing equipment leasing and asset financing in Mexico. It's a market that is having essentially a renaissance of manufacturing. You have kind of parity with cost with Asia for car manufacturers. There are more TVs made in Mexico than there are in Asia right now, and you have a much lower cost of delivery. So it's a market we'd like to get into. We've been spending a lot of time exploring it, and we found a partner down there that uses technology, we think, in the most clever way to perform underwriting. In Mexico, you have a requirement to register your invoices upon receipt of any capital. So we have a technology platform down there that looks directly at registered invoices, looks directly at tax information, VAT filings, has direct access to bank statements, which allows our underwriters to cull all of this data and then make an independent reconstruction of the financials. Imagine if you could look at any credit package that comes into you as a lender and be sure that the information is verified, because that's the shortfall, right? In any lending environment is fraud and not having good integrity of data. Technology today allows us to weed out that fraud by having independent verification, and if somebody won't participate in the verification process, well, that helps you weed them out right from the start. So kind of the important thing here is really kind of using the technology, but understanding where its place is. So will it blow up? Will alternative credit blow up? No. There will be, some individuals among them, and there will be some frauds, and there will be bad press, but the good fundamental strategies that are being run with a good, diverse investor base will persevere. And I agree with David entirely. This will be the primary market, because for it not to be, you have to expect banks to become less rigid, more flexible, which means less regulation, more ability to be innovative. There's no incentive within kind of the regulatory structure or the governmental structure to provide that type of leeway to banks. With that said, you can expect your bank to probably be, well, at least for now, your mortgage lender, your probably not even your check deposit institution for long. I guess the question really isn't, is alternative credit here to stay? The question should be, are banks here to stay? Because there's really kind of no functional use to them at kind of generation 2 of alternative credit as we see it today. The real risk, I think, to alternative credit is consolidation driven by regulatory cost and reactionary policies which limit innovation and the ability to meet customer needs. What does that mean? Kind of every big participant in the alternative credit space risks becoming GE Capital. That could be a great thing on the way up, but GE Capital was a non-bank financial lender. It dominated the global market in the space. It did incredibly well. It provided, I think, quite honestly, to the innovation of the United States as a country. And then it became a bank, and it became the most regulated entity in the world, and it is now what it is. It's being deconstructed. So anybody in the alternative credit space can almost be a victim of their own success if they get too quickly, if they don't manage the regulation too well, if they become essentially a bank, right? That should be the warning sign to alternative credit. Don't be a bank. Remember why you got into this business in the first place. To be more nimble than a bank, to be able to extend credit based on rational decisions and good information, to be, there to meet your customer needs. So that, I think, is the risk. Will banks exist? I don't know. I think that any alternative credit provider that becomes a bank won't be long for this world either. So what is the investor's perspective here? According to an informal survey conducted by AltFi, which is our friend over here specifically, the average institutional investor expects low interest rates to persist until 2048. I don't know what happens in 2048. That really became that cutoff point. But there's a good reason to believe that. If you look around, and I'm saying we probably all think about interest rates way too much. There's no signs of drivers in the near future that will drive up interest rates. Maybe over time, 2.5%, but that's still essentially a low interest rate environment. If that's the case, from an investor's perspective, you have no alternatives but alternative credit. Because at the end of the day, that's the core of financial investing. So investors will always need yield, and you'll always need cash flow. So I think that alternative credit will be supported purely from an investor's need perspective. So now this is where I kind of move into plugging kind of what we do, feeling that we should be talking a little bit about some of the other alternative credits like equipment leasing, what we do. Remember, the drivers for investors are cash flow, collateralization, yield. Non-correlation was also a primary driver into alternative credit from an investor's perspective. Now, over the last couple of years, there's been somewhat of a proving out of what is and what is not non-correlated. There is one asset class that I believe to be less correlated than all others, and that's exactly what we do, and that's equipment leasing. So I have 10 minutes, so if you would indulge me, I'll talk a little bit about our specific asset class, equipment leasing, why we think this plays a crucial role within the alternative credit universe. So what does, and equipment leasing really is, from where I'm discussing it, is middle market equipment leasing. So you've got the small ticket equipment leasing, which is kind of perfectly in line with kind of the direct lending, the marketplace lending. It's small ticket, it's very efficiently credit scored. You aggregate them, you securitize them. We believe that that segment of the market is kind of more correlated than middle market equipment leasing. And that's because at the end of the day, just like a lot of the direct lending, your end user is a consumer, essentially. So you're tied to consumer credits. Also, middle market leasing provides a good degree of diversity that you don't see in the large ticket asset leasing like aircraft, oil rigs, things of that nature. And overall, when you look at equipment leasing from the middle market perspective, what you're getting is a collateralized investment that generally generates yields above commercial paper of the same tenure of the same counterparty. So we think this is a pretty good subsegment within the alternative credit space, within the leasing space itself. So how does it work? It's quite simple. I know everyone talks about kind of the simple loan relationship between borrower and lenders. Essentially, this is a loan relationship between a borrower and lender secured by a piece of equipment. So essentially, an investor in this particular situation buys a piece of equipment, enters into a non-cancelable lease for that asset, usually at a loan to value of about 80%. So you have equity in it. You have a fixed payment stream that comes in. And you generally have the opportunity to invest in assets that have liquid secondary markets. So in the event that you don't get your fixed payment stream, you have an underlying asset that can then be redeployed elsewhere. We think there's also opportunity for returns beyond the base term with equipment leasing. So the question is the same that I was asking on the alternative credit spectrum. Why do businesses lease? Why do businesses need alternative credit? In this situation, it's to acquire capital equipment. It's the easiest way to do that because you're looking at kind of a dual underwriting strategy. You might not have to stand alone from a credit perspective. You may have kind of some enhanced collateral that's not real estate. And lenders, banks particularly understand real estate lending. Not a lot of people understand kind of equipment lending at the middle market level. It gives businesses flexibility of their inventory. It's always about cash flow management. The reality is that every business that has capital equipment leases, if you look at FedEx, for example, if FedEx were to spend all its capital on purchasing its airplanes, it would have no capital to run its business. So it's a cash flow management tool. So like I alluded to earlier, equipment leasing is a unique segment of the alternative credit space because it's both an asset investor and a credit investor. I won't go over the particulars of what we look for, but it brings another element of collateralization kind of beyond the real estate, the personal guarantee. You're looking at a hard, tangible asset underneath this. So to bring the point to bear, I have a couple examples here, but I think I will skip it as I'm coming close to the end. But let me use this as an example as to kind of where we fit in the alternative credit spectrum. There was a company in the Netherlands that was acquiring a business in Ohio in the United States. The business was providing set-top boxes and individual Wi-Fi hotspots to 4- and 5-star hotels throughout the world, but primarily in Europe and the United States. They were kind of top-tier hotels like the Grosvenor House in London. So, the reality of business travel today is if you check into a hotel, you need a hotspot. What they've done historically is they've put a Wi-Fi device at the end of a hallway, and depending on where you're located, relative to that and relative to the usage, you would have a varying degree of capacity. What this company does is provide an individual hotspot in each room with full strength and on a secured basis. So the Dutch company was purchasing an American company, and they had this portfolio of equipment, essentially. They could have financed that through equity, which any business owner realizes you prefer less dilution. They came to us, and we were able to provide equipment financing, which served as the capital to finance the acquisition. So again, it's an alternative credit strategy for M&A in this circumstance. So we also did equipment leasing for a hospital in Arizona. This one's particularly interesting because we came to meet the operators of this hospital who had built and sold 5 hospitals to date. They had picked Green Valley, Arizona, which was a community of 50,000 people with an average age of 72 years old, with the closest hospital 45 minutes away, not by a 72-year-old driving. So they brought us in, and the first question we asked was, why us? And they said, first we went to GE, and GE said, we'll do the GE equipment, but we won't do the Siemens equipment and we won't do the Toshiba equipment. Hence, GE became a bank. Then they went to Bank of America, and they were 6 months into the credit process with Bank of America with no indication as to where they were going. So they said, we know how you guys operate. We know where you get your capital. We'll pay a premium for certainty of execution. So that story really encapsulates where alternative credit fits and why it exists. If not for our financing, they might still be in the credit process with Bank of America. So with that, I'll just illustrate one final investment that we did make, and that was the remote operated vehicle over in the right-hand corner there. And this is really important because this is a lease that was to a company in the North Sea, and the lease went into, the operator went into administration or bankruptcy. The company went into liquidation. We went up to Scotland. We said, that's our asset. We pulled it out of that particular company, and within 30 days had it deployed on a long-term charter with another company generating a yield in excess of our original. So it proves that the collateral is real, it's liquid, and it's not just window dressing beyond just a really enhanced credit package. So with that, oops, I'm going the wrong way. I will open the floor to questions if anyone has any, and I thank you for the time today.